We'll give it a couple of minutes still to start to get more people in the webinar. Okay, we'll give it 1 more minute or 2 minutes. Okay, it's 3:03, so I guess we'll get started. I guess probably some more people will join during the webinar, but yeah, like let's make sure that we take the most of the time. And I think today we'll probably end maybe a little before 1 hour, because I guess we'll try to cover a very extensive topic, but then like we'll do just like a brief overview in each of the main startups business models. So I guess yeah, like let's not be like too short or too long in each of them to make sure that that we cover all of them and we try to be exhaustive. Although obviously for each of these topics we could go in much more detail. In fact, for example, for SaaS, we will have a specific webinar. I'm not sure if it's the next one or which one in the series, but yeah, like SaaS by itself already like could have, I guess, a whole webinar series, and same with marketplaces, e-commerce, and so on. So, well, I'll share my screen, and yeah, and I think you can see probably the presentation. So we'll talk. Yeah, we'll have like a bit of an introduction. If you have been connected to other webinars, I'm sorry, because it's going to be again a little about me and about the Startup CFO and what we do, and then try to cover 15 minutes on SaaS, 15 minutes on platforms, marketplace, and e-commerce, and 15 minutes in other models. And like always, I'll try to leave some time at the end for questions or whatever if there are any. But like always, again, feel free to stop me at any time. We are not too many, so I think it's very reasonable if you just like unmute directly, or if you like write something in the chat, if you use the function of raising hand in Zoom, or whatever. I guess we can make it more conversational and not just wait for the questions in the very end. So, by the way, why did we choose this split? I guess I'll mention it afterwards, but in many times the startups work in very different industries, obviously. So startup is a type of business, but not obviously it doesn't imply the industry that it works in. There's like biotech companies, there's startups in logistics, there are startups that are pure software for business and whatever. But I guess that rather than an industry split, it makes more sense than to split them in business models, because that certainly you can fit like most of them within certain business models. In fact, as we will see later, many times the business model itself is the novelty and the innovation that the startup is bringing. But in any case, obviously, we still have like this section of other business models that are like in particular the startups and that you always need to have, essentially. Like, for example, here we will cover Fintech, we will cover like very startups that are like very heavy on R&D, and that's the true worth of the company. We will also cover startups based on data, which is also like always that is very common. The typical thing of like if the product is free, it becomes that it means that you are the product and things like that. Anyway, let's start moving on. So first of all, I'm Jaime. As if you have been in other webinars now, I studied physics between Madrid and Boston, and in fact, I started a PhD. I never finished it, so then is when I switched to business and then my career, like closer to what I do now, which is I started as a consultant in McKinsey & Company in Madrid. And then after a little less than 2 years, I started working in startups and in finance. So my first two startups were On Track and JobLink, that are startups based in Madrid. Actually, again, one in logistics, the other one location intelligence software. And then I started having like projects as a freelance that many people that were like former coworkers or colleagues or friends of friends or whatever asked me for some help with the financial part of their startup, like a reporting, business plan, and stuff like that. So then it's like I started having projects as a freelance. Then I started working as freelance full time, and then is when I decided to scale the company and to scale the business and create the company, the Startup CFO. What do we do in the Startup CFO? Our main focus is to provide fractional CFO services for startups. So startups that are early stage that still are like less than 50 employees, usually that have raised less than 15 million, stuff like that, count on us to cover. They don't need a full-time CFO, and count on us to cover like everything related to business planning, anything related to reporting, like financial processes, fundraising, stuff like that. So by now, we have already worked with over 75 early stage startups as fractional CFOs. And in fact, including other business lines, we have served a total of, I think, almost 200 by now. So we recently opened our first international office in Berlin. Actually, we're very excited about that. We already have clients there. We have a very good relationship with many of the important early stage funds in Berlin. And we have a physical office there and employees there. And also, if you're interested in more content like this, you can visit our YouTube channel or you, of course, join this series, this webinar series that we are right in the middle, I think, right now. This is the 4th webinar we're giving, and it's a series of 8. So, if you signed up for this one, or if you receive the link, if you sign if you sign up, like you will receive like the invites for the next webinars as well. By the way, in every webinar, I always say that feel free to ask us for the files that we show for this presentation or whatever. You can always send me an email and ask us, like many people usually do. So I'm writing my email here, Jaime at tscfo.com. So feel free to send me an email and ask for the slides and the materials. Anyway, so why this webinar? Although I covered already a little bit. So the startups work in very different industries, but still it's relatively easy to group them by business model. Meaning like the way that they make money. Like one of the things, like the product they do, the technology, the problem they solve, but then it's like, what is the business that they create? Like, what is their way of making money? In fact, for many startups, that's already the innovation, as I was saying before. So for example, Uber, it's a product that in the end is a taxi, that already existed, and obviously it's fine. But technology allows you to create a marketplace-like business based on Uber, and and as it works now. But the product itself, the problem and the solution, it already existed. But the thing is that now there's a new business model. In fact, as we will see with SaaS, SaaS is obviously something that only exists like with the cloud and with the internet and stuff like that. So that necessarily needed that innovation. But then for many products, we are offering the same, but with a new business model. And then each business model has some specific metrics and dynamics that are very similar, even in very different industries. This is actually why we can be a specialist on startups. Like if in other industries or in other types of businesses, you would be an expert on a certain industry itself, but not so much on a type of company. So the reason why we can be experts on like this particular type of company, and that are startups like with huge uncertainty as they usually do, is because in fact they usually fall under the very similar business models. So that's why we can model them and know and have expertise and know benchmarks and stuff like that. Again, even if they work in very different industries. So, moving on. Let's start with SaaS. SaaS, I would say, is software as a service, and I think it's the most common type of startup. I think it was, especially like some years ago, and it still is like pretty high. I guess there's like at the beginning, like when in the .coms and the beginning of the year 2000s, it was more on e-commerce, for example, and marketplace. And I guess SaaS is like a business model that arrived to stay. I would say that probably like half of our clients are SaaS, or maybe even more. The definition is a cloud-based application delivery model centralized on a server. Instead of downloading or installing the application, the customer can access the product through the web. Essentially, any web that like you pay like a recurring fee, or any service provided like by the internet that you pay a recurring fee to access, that is a SaaS. From Netflix, for example, to an ERP for a company like SAP, that'd be like a huge SaaS. Salesforce, for example, that most of our clients use either Salesforce or HubSpot. That's a software that you pay recurrently and that you use it. Essentially, you access through the internet. So there's like actually, yeah, I think I'll say like in the next slide, like that there's like so much SaaS that currently companies pay right now. What are the advantages? The advantages are huge, and both for the customer and for the company. First of all, you need internet connection, and that's it. You don't need like even to download whatever. You just need like whatever browser you're using and access. Very simple and accessible, compatible usually then with all devices, because you need a web browser. It's true that many times they are focused on like a laptop, especially if it's for businesses, or a mobile if it's B2C. But essentially, like the compatibility among devices is not a huge thing. No licenses are needed. Back in the day, if to install Windows or Microsoft, you know like either like bought a CD and like installed it in your computer, and you paid like one off, and then you had like the license, and there was like certain code that you need to put and something like that. In most cases is a subscription model right now. Even Microsoft, by now, I think you pay, at least in companies, around 10 euros per month per user, something like that. So also, well, this is more technical, but like the company is responsible for the data security. It's way more scalable, and this is why that's like really important for the startup. Like for many of our clients, if it's truly a SaaS, if it's like if the customer service is not like something particularly important or heavy, they wouldn't mind selling 1,000 licenses or selling 10,000 licenses. Obviously there are like some costs associated to it that would increase, like the servers, for example, and like obviously it's not as easy to handle a company with one client and with 10,000 clients, but the product by itself, it's just like new download. The harm, the impact that it has on the company, it's very tiny. Back in the day, also, for example, for scalability, if you want to sell more, probably you need to, it depends on the product, obviously, but you need to spend more money on marketing and sales, and it's like more predictable, like what will happen. Back in the day, the way to deliver the product to the customer was like through stores that would take some margin, and you needed like to ship the products and stuff like that. So that doesn't happen anymore. Then it's easy to personalize. Again, comparing to CDs in the past, you maybe bought like one version of it and not the other version. Right now, it's very easy. Like in HubSpot, I can go like right now and create an upsell, and say like, okay, I want this functionality instantly. And then, I would pay a little more for it, and I have it like from that moment exactly. Back in the day, obviously, you depended on on like maybe a different patch or a different version of the product. And very important as well, you can always make like automatic updates for the product. So if you improve things, one day you open HubSpot and there's like a new interface or a new functionality. In fact, for example, right now, a ton of softwares, even like Microsoft Office, they are like adding artificial intelligence functionalities. That is, something new that came. And now in Word or in Excel, you can already see some functionalities and you didn't need to do anything. So, as you see, many advantages for both the business and the customer. And in fact, this is why there's a huge trend towards SaaS, or even what is called like many times XaaS, like anything as a service, or SaaS, or however you want to pronounce it. Even like our services, like many people, they call it like CFO as a service, to understand that is like a monthly fee that, well, you pay it, then you have access to this service. Of course, we are not software, but and of course it's like an abuse of language, but it makes sense, or it like triggers the same kind of mentality for the customer. In fact, like Microsoft was obviously huge on the opposite, on on-premise software, and right now it depends like way more on cloud. This I found that in Apple obviously lives of hardware that they sell, and that's a different business model, very profitable, of course, for them. But even then, even in Apple, they are like monetizing more and more, like as much as they can in like monthly subscriptions, or like or whatever they take from their softwares. Then there's like some statistics I found over here that it says a little outdated already, but I think it provides the same message. 73% of organizations are using all or mostly SaaS solutions. And nearly 85 of small companies have already invested in SaaS options. Well, that even more, I think. 93% of CIOs adopting SaaS. Organizations with over 250 employees use more than 100 SaaS apps. I think even like we are a tiny company of 25 people, and I think we are probably in the tens, in several tens of SaaS invoices per month. And yeah, well, it says like up to 50 employees, 25 to 50. So yeah, that makes a ton of sense to me. And here like some evolution of like revenue in the industries, and you see like how like the market keeps increasing like very, very, very fast. So in SaaS, again, we are going to cover like a full webinar, and then like I don't want to go too much in detail, although we could. But if anything that it's important, and I will show you now like an example from a real client that we have, obviously with sanitized numbers, it's very, very, very important, this concept, the concept of MRR or ARR that you may have heard. I'll explain the difference at the end. So the MRR is the monthly recurrent revenue, and it is the sum of the recurring monthly income that each customer brings us at any given time. It sounds easy, but it has like many subtleties here. So it sounds like simply, okay, the revenue that I have each month, right? Because it's like the sum of the recurring monthly income that each customer brings us. But let's go in detail. Monthly. The monthly means it's not necessarily what is billed. So as I put in the second bullet, if we invoice 12,000 euros for an annual license on January 1st, the MRR means like is 1,000 euros per month, not like 12,000 euros in January and that's it, but rather 1,000 euros per month. It's not related to the invoice, and it's not related to the collections either. That's like something separate and something in accounting. And the other important part is recurring. It must be the recurring revenue. So most of the VC funds, what they really want to see is recurrent revenue, because it's predictable and because they can count on it in the future. So in the MRR, it must be like the figure that you need to add is the recurrent revenue. It may not be all your revenue. In fact, as I put in the third bullet, it is very typical for a SaaS business to have also like non-recurrent revenue, that it can be from consulting that they do, or another service line. In fact, it is a good practice that a SaaS company does this. Many times you do a project like a one-off, like a consulting project, and then you incorporate that in your product. You'll learn about it and you incorporate that in your product. So, but then obviously there's here like some thin lines. It's like, okay, but what if it's a pilot? This is the typical question that we get. We did a pilot of 3 months with this client. And our way to distinguish it is if it is something that your goal would be to extend it, like, okay, we do 3 months because we just signed this contract, but the goal is that then they keep extending it and they buy the full license, then it's something that I would consider recurrent. If it's a one-off project that you have done for several months, but like you know since the beginning that it will not last forever, then it's not recurring. And again, it's the more recurrent revenue, the better. That's like the metric that the VCs are gonna look at the most. And in fact, many times the multiples, like the valuation for a SaaS company is a multiple of their MRR. So the more the better, but don't dismiss the non-recurrent revenue. In the end, the non-recurrent revenue is funding for the company. And again, it's the way to learn. Still, for us, it's a little weird if that's more than 10% of the revenue of the year. It's like, okay, it's very normal that you have like non-recurrent stuff. Also, by the way, setups, it's like very common if the company charges for the setup. But if like there's too much revenue that is not recurrent, then we wonder like whether it's really a SaaS company or maybe it just has a SaaS business line. So that's that can be a little tricky. Also, by the way, with like the recognition of revenue, which related with the second bullet, there's also like sometimes thin lines. So maybe imagine that you invoice something and then like in the end, you need to correct the invoice a couple of months later and submit a new one, or the client started using the product like with some months delay, and your MRR then maybe like different than your revenue. And that's totally fine. And it happens with our clients. Also, for example, for currency exchanges, it is very common that the formal revenue in accounting is different than the revenue than the MRR, sorry. So that's completely normal. But again, let's say if the difference is 5%, it's okay. If the difference is 50% between your MRR and your accounting revenue, something's weird. And we see that often, actually. It's also like a terrible practice if you do not defer your revenue, and if you do not put like in this example, the 1,000 euros per month, but rather you put the whole revenue in January. It's actually wrong. So yeah, and actually that triggers like then that the difference between MRR and revenue is huge, and it's difficult to solve actually afterwards. So this point is very important. By the way, I mentioned at the beginning that you may have heard MRR and ARR. The difference is simply monthly recurrent revenue, and the other one is annual recurrent revenue. So the difference is just a factor of 12. Like, don't confuse it with the annual revenue. It has nothing to do with it, but it's just the MRR times 12. It's like if this month were a whole year, then we would expect like revenue a revenue of, imagine, 1 million. So many times, for example, a good rule of thumb for SaaS valuations is 10 times ARR. You have an MRR, imagine, of 100,000, then ARR would be 1.2 million, and then the valuation could be 12 million. This, don't take it too seriously, but it's a good rule of thumb. If the company is growing a lot, if it's like a great business, if it has no churn, stuff like that, if you have like many VCs interested in investing, then it can be much higher than 10 times. And if things are not going so well, then it can be way less. Anyway, we will cover like in more detail, but let's see an example that I guess you're seeing now, right? You should be seeing an Excel file. So this is like typical reporting, pretty old, as you can see, from a SaaS business. Again, this is based on Graphics, a good client of us since more than 3 years ago, and sanitized figures. So don't trust them; they have nothing to do with reality. So this is always what we plot. So the MRR is the most crucial metric, and it's the one that we really need to track. Again, not necessarily their whole revenue. They may have other business lines or whatever. And as you see, the breakdown like we break it down in different in different like sub items, which we got new MRR, reactivation, upsell, downsell, and churn. Again, we will look at this like with more detail in the future. But the good thing about a recurring business is that you can count with most of your current revenue for the next month, for example. So from one month to the next, you're gonna have like the same customers, but some new customers, some customers that now are paying more, and maybe some clients that you lost. But the bulk of it is recurring. That's why, again, an investor loves to see like a recurring revenue. In fact, there's something very important. Like for a SaaS business that is already making a substantial amount of money, let's say maybe 1 or 2 million ARR, it is very easy to become profitable whenever they want. Meaning that because your product is inherently recurrent. So obviously you may have like some churn or whatever, but hold on one second. So you may have some churn or whatever, but if you and you're investing a lot on keep developing your product, and you're investing a lot on new sales and new marketing. But if you decided not to, if you cannot raise a new funding round, if things are not going that well or whatever, if you cut your staff in half, for example, then the company would immediately be profitable because you already count with that 2 million revenue. So if you downsize the company, obviously nobody wants to do that, and it's a traumatic process often. But if you wanted to, then you could become profitable. And then it's like a SaaS that is already big enough. It's somewhere like where I would be happy to invest, knowing that it's unlikely that I don't lose all my money. Again, VCs usually, as we will see in later topics, VCs usually like to invest in things that can like become huge, obviously, and not lose money. But as Warren Buffett said, the first rule is not lose money. And then like in SaaS, you can do the same analysis of like the number of clients or accounts that you had, and then like some new, some upsell, some churn, whatever. There's also like many other metrics that you can track. Again, I'll go very fast because we will see it in a dedicated webinar. But yeah, like average new MRR per account, reactivation, upsell, downsell, then there's like it also has something particular that it has is that it has like a very special vocabulary. Like the MRR, we also talk about ACV, we also talk about ARPA, which are annual contract value, average revenue per account, the bookings, which is the amount that you sign per month, and stuff like that. That's like particular SaaS vocabulary. Not particularly hard, but it has its own vocabulary. And then we see here like some metrics that are that we can calculate in every business. That is like the LTV CAC or the payback or sales efficiency. That I think we already covered. Yeah, in the first webinar we covered these 3 metrics. And then in a SaaS, there's like a way to calculate them that we will explain in the dedicated webinar. So again, feel free to stop me at any time. SaaS is usually hot topic because it's like a very common business model. And then we move on to platforms, marketplace, and e-commerce. In fact, the first question here is what is the difference and what is the definition of each of them? Because they are not the same. Especially, I think people tend to use the word marketplace meaning platforms more often than they don't. I'll explain like the formal difference, and it creates some difference in the dynamics of each of these types, but I won't go into much detail. And I guess that later on I'll be talking about marketplaces in general, meaning both of them, meaning platforms and marketplaces. E-commerce is a different beast by itself. So platforms, in a platform, the provider of the service is the platform. So for example, when I go to Uber, I ask Uber to provide me the service. I don't go like to that particular driver, and the driver is not responsible. He will be responsible to Uber, like any employee to his company or like any contractor to its employer. But I go to Uber and they need to guarantee the quality service. Rather, like in other examples, I don't know, in eBay, for example, it's the particular seller that you are like contacting and making business with. That creates difference in dynamics, and we'll talk a bit about marketplace dynamics and liquidity. Again, not too much because we could go forever, but I'll try not to say too little, such that I can make it meaningful. So this again is a little outdated, but I found it like pretty funny how this slide started with Agora in Athens in 600 in the year 600 before Christ with the first marketplace, and then they move on directly to 1991. So, but this is actually pretty much true. Again, with them with the rise of the internet and technology allowing it, is when we can have like different business models, or business models, or apply a business model that existed, which is like obviously a marketplace, and and connect buyers and sellers, but in a total new way that disrupts completely like what existed before. So they had here, they said 30 million users 2016 just in UK B2C digital marketplace. And the UK has a population of like 50 or 60 million or something like that. I guess by now, especially after COVID, it's way more common. And a market of 6.7 trillion, they said, by 2020. So huge. Some examples of platforms, I would say Uber, like the example that I already said. On Track, I put On Track because it was my one of the companies I worked at. On Track is, to put it like in quick words, like Uber for freight transport, so transport of goods, B2B. Then Delivery Hero, for example, but I put already 3 dots. And why is that? Delivery Hero has it's partly a platform, because, for example, you don't pick who is like delivering the food or whatever you order, but a marketplace in like what restaurant I want to order food from, for example. So that could be a little tricky. Then Facebook, do we consider it a platform? Yes or not? Then they monetize in a totally different way, but they have dynamics of a platform. And then you see like a ton of content that people use to put in the platform. And Shopify as well, it's a platform in the sense like it itself, like it helps e-commerces. It monetizes as a SaaS, actually, but so like it can be argued. I mean, I found like many times like the platform to build your e-commerce, but it would be arguable in my opinion, and it doesn't monetize as a platform. Then marketplace that are like most common, Airbnb that everyone knows. I put WTransnet as a counterparty to OnTrack. WTransnet is a Spanish company. I think it's Spanish. I'm not sure actually, but they do similar like freight transport, but they just connect people that can do deliveries and people that like need deliveries. eBay as a huge marketplace that we all know. Upwork that you may know, like for freelancers, to connect freelancers with people that need freelancers all over the world. And Tinder, again, with a question mark. Tinder, obviously, is like it has dynamics of a marketplace, like, people that want to meet. And but there are like 2 special things. One of them is like there's no supply and demand. So there's in that part is like both parts are equal. And second, and more important, they monetize as a SaaS as well. But we will see that even if they monetize as something different, like the marketplace dynamics are crucially important. And then e-commerce, I guess it's more easy to recognize. Amazon, Zalando, for example, they are huge. And then I put 3 of our clients that I wanted to show a bit. Baya, for example, actually we'll talk about them later as well. Baya is a marketplace of organic food, refrigerating the fruit delivery for companies, and Plantarse, a vegan dark kitchen. So the key equation, like similar with the SaaS and the breakdown and stuff, to track a marketplace or a platform, it is to have always like a number and then many ratios that allow you to track different KPIs and to track them in time, and it makes sense. This is actually very important. If you have a tiny marketplace, imagine Amazon when it was like, I don't know, 1,000 times smaller. They still could track like these metrics, and they probably would be more or less related to what they are now. So for example, they have like a customer base and then part of them are active. Or among their customer base, they do like, I don't know, several purchases per month. Maybe at the beginning it was 3 and the average, and maybe now it's 6. I have no idea. But it is a KPI that they have been able to track in time, even if the company is huge, like it is now, or even when they were small. Then monetization, again, like, are we selling? To go one by one, is like acquisition, and the responsibles are sales and marketing. Marketing of creating new leads, sales of closing them. And that acquires like your total number of customers. But then from those customers, how many of them are active clients in that given month, if you're tracking it monthly or weekly or yearly or whatever. Among those, how many purchases they do, the recurrence. Those purchases, what is the average ticket? You prefer that they are more expensive rather than cheap, and that they keep buying like more expensive products. And of those, what is the margin I keep? Of course, I'm not saying that Amazon tracks only 5 KPIs. Obviously, they will track it and track it like for different types of services, different countries and stuff like that. But still, the logic of it goes, it follows this mindset. So there's a couple of things to mention. Well, by the way, I said Amazon. We'll see later that with e-commerce, this is crucial, but also something else. But yeah, or like with any app, with any marketplace, it works the same. Amazon, by the way, is partly marketplace, partly e-commerce, actually. So it's a little more complicated. For this, the acquisition and retention is not necessarily this very simple equation. And in fact, it's usually more complicated, but the goal is the same. For example, something that can help you is cohorts. We will have also a webinar on cohort analysis, and that is crucial, like how the people behave after certain months with that they have been active, for example. So you may see that the clients that are more mature take like spend more, for example, or like do more purchases than at the beginning. In fact, for example, in On Track, that was like freight transport, clients at the beginning trusted you with very few deliveries and very small and non-important deliveries for them. And then in time, they started like using it more and using it for longer services or more expensive services. And again, probably the first time you tried Uber, you used it only twice that month, and then now maybe you use it 10 times. And then, so like these are, again, different ways of calculating it, but always following more or less this structure. And then there's a concept that is very, very important that I won't go into much detail, but I want to introduce, which is the concept of marketplace dynamics. Marketplaces are very difficult to run, and they are very difficult to model as well. And I'll explain why, because all of them are different. So with SaaS, you can read a book on SaaS that probably applies to almost all SaaS business, or you can, like, there are many blogs, websites. Actually, I recommend one that is called the SaaS CFO. And you can track it and you can see that, they are like more alike to each other. But marketplaces are completely different among them. Why is that? Because marketplace can have, for example, a different number of stakeholders, like we will see now. A different locality, for example, that I think we will see also another example. Some of them are for very urgent services. Some of them are for services that are not urgent. Some of them need to be in the same country, and some of them are in the same place physically. Some of them don't even need to be in the same country. So each of those create very different dynamics. And the concept of marketplace liquidity is when you have achieved like this critical mass and see how it behaves. And you see that the supply is matching the demand and stuff like that. In fact, by the way, usually in marketplaces, most of the times is the supply that is not meeting the demand. The supply side is the problem. But again, I think I'll give some examples, and I think I have these 3 splits that I hope I convince you how annoying marketplaces are. And again, this is why they usually given like the concept of liquidity, and that is they are very difficult to run. These are models that need a lot of money to be set up. Many times they take a small margin, so that's why it's a winner takes all market. So you need to put a lot of money, and then they keep merging very often, and creating like a winner takes all market. So, for example, Delivery Hero, or Glovo in Spain, or like Uber Eats and stuff like that. It's a delivery model with 3 parties. Like you have the courier, you have the restaurant, for example, and you have the client. So the 3 of them, it's already like a problem that you need to handle 3, and you need to acquire the 3 of them and to please the 3 of them. But it's especially problematic in that case, as we will see later, that it's very urgent service that you order it for now, and they need to meet at the same point first, the restaurant and the courier, and then the courier and the client. So it's like very complicated operational. Also, well, many marketplaces, and I guess like this is this is like the most common, or like the ones that comes to mind, have 2 parties. So, like again, with Untrack, like a driver and a client, or with Tinder, but again, it's not easy to split the supply and demand in that case. And again, it doesn't monetize as a marketplace. Tinder monetizes with premium subscriptions that are like a fixed fee per month. So you need to analyze the SaaS part of it, and obviously you could do like the MRR, the upsell, the downsell, the churn, whatever, and I'm sure they do the cohort analysis, stuff like that. But of course, the marketplace needs to be healthy. The marketplace needs to have like both parts that like are meeting like their demands, and they find what they need to find, that they don't churn. You don't want them to churn. So the marketplace dynamics are crucial. And then there are marketplaces with only one side that is actually like same people in different times. An example that is very well known in the US is Craigslist. Craigslist is like classified ads, more or less, provide like any kind of product or services over there. But then people would go like to either sell stuff or buy stuff, for example. And then Circular, which is a former client of us, they are like a marketplace in which like recruiters that didn't hire someone can but it was a good candidate, they can put it there for other recruiters to hire them. And actually, the recruiters are either the client or the provider, depending on the moment. They can be both supply and demand. Then there are marketplaces that in which the relationship between the parties is different. Many of them is market pick. So, for example, if I get an Uber, I don't choose what driver comes to me. Or again, with Delivery Hero, I don't choose the courier, but it is a buyer pick market in choosing the restaurant, for example, or in eBay. In eBay, I go and I choose whoever. And then some of them are double: Airbnb, Tinder, of course, and Upwork, for example. So, this already creates very different dynamics, because if it's market pick, which is usually the platforms, is you need to run, and you need to provide like a really good service and make sure that the people that you are sub-hiring, that you can trust them. And that implies training, for example, and a system of like who are the best drivers and who aren't and stuff. Like actually these companies, I met a guy from Cabify, which is like the Spanish Uber, and told me like how it works with him, and it was very, very interesting, the dynamics that it creates. Or like the double, there has to be mutual choice. So you need to make sure that they are matching, and that part goes fine. And by the way, that they match through you, or like the payments and the margin that you're taking, that it goes through you, if you're monetizing that way. And this is also super complicated, and this you will understand why I put the logos in this fashion, is the locality. Some are absolutely local, and some are absolutely non-local. And with the weirdest example, for example, in Airbnb. So with Tinder, for example, it couldn't be more local. Like people use it to meet and to meet in person, obviously at the same time, at the same place. Delivery Hero, almost, because obviously locality is crucial, but there's actually a delivery. So like moving something from A to B is very local, of course. Then corner job or companies that are like for to find jobs. Usually you market in the city where you are, but now with remote work and stuff, it's a little more complicated. Or people may be willing to move. Airbnb is the weirdest. Airbnb, I'm sure that is like pretty difficult to handle, or especially at the beginning, before the virality, because your supply is literally where your demand is not. So if you want to open the city of Miami in Airbnb, then you need to find people outside of Miami. So that creates like very, very weird dynamics. Then Facebook, well, the way they monetize it, but obviously like we're getting less local depending on what business line they do. eBay, there's a delivery, but it may come from Australia. And the biggest example of non-locality is Upwork. Upwork, I may be hiring a freelance in Kenya, and we work together for 5 years, and then and you've never been there, and it's not even important the timing. The timing is not that crucial. Usually, emails are fine. So all this creates that each of these examples that I put over here are completely different. So it's not so easy like to take lessons from one to the other. And many times, like if you create a new marketplace, you are reinventing the wheel, because no wheel like yours existed before. Even like businesses that look very similar, like Uber and On Track, again, I explained On Track like Uber for businesses, are very, very, very different. And again, the other day, talking with a guy from the Spanish Uber, we were like very surprised of the differences and the dynamics of it. Like for example, in On Track, usually the deliveries were planned, so you could like model the routes for each driver, which it didn't happen in Gabify. Well, that's actually where the margin is. It's very complicated to create a platform or a marketplace. If you are doing that, good luck, but be ready to recreate it yourself. And then with e-commerce, I guess I'm running a little late. In the end, I end up talking too much always. With e-commerce, obviously, well, no need to explain that since COVID, especially, it's become huge. So the people that claim that we're more likely to shop online. But well, as you know, e-commerce is a huge thing, especially after COVID. And then in e-commerce, obviously, like everything that we said before applies. In fact, I gave a couple of examples of Amazon in that. But something important is that the sales funnel is more important than sales themselves. Okay, so what do I mean by that? That you need to track the whole path of your customer and your potential customers. So you have total sessions of people that open your website. And then among those, there are sessions that visit a product. Among those, sessions that added a product in cart. Among those, some that like were purchases, then that had an average ticket, and then you kept a certain margin. And again, these are KPIs that you can track forever. What are the subtleties here, or some important comments? First, that the sessions is very difficult to track if it's the same user, which that's something like pretty painful. And also many times is difficult to track where they come from. For marketing, this is an issue. And then you are probably, I was very surprised that like 70%, like the abandon rate, what means like sessions that had a cart but didn't end in a purchase, is around 70% in an e-commerce on average. I find it huge, and I found it difficult to believe, but then I kept looking, and it's like something like that. So I guess like it was unexpected, like when e-commerce started. It's like, people when they go to a shop in the street, usually they go, and if they put something in a bag, it's because they're gonna buy it. But online, we're way more used just like to track down and then add to cart, and then you forget, or then you decide not to buy it that day, or postpone it, or buy something else in another day, whatever. So it is very, very, very important to track the funnel from the beginning to the end and see where you're failing here. There's also, obviously, by the way, I'm oversimplifying things, and there's like many, many other ratios that you can track in e-commerce. In fact, Shopify has a very cool list if you look it up. Also, for example, the bounce rate is like visits that only visited one page, that didn't like kept swimming in your website, to put it that way. And e-commerce, well, I guess the two main difference, the biggest difference is the ones that are natives or the ones that are complementaries. This happens in many industries, and usually like native startups or native technological companies have like a better delivery or a better look and feel and stuff like that. Also, that's the reason why, for example, you would have expected that Walmart, like if you want to start Amazon and you see that it starts, I'm sure that many people told the good Jeff Bezos, yeah, but like whenever Walmart wants, that has like literally 2.5 million employees or something like that, they have so much more money than you, and they can open it and in 1 second destroy it. But not, because in the end, like the digital culture that Amazon brought from day one is what made them win. And an example, I have like, well, some stupid example here that I showed. Obviously, it's more complicated, but you need to track simultaneously this for marketplace. This actually is like a very, very simple model for on track the supply and the demand separately, but with very similar KPIs. Like, for example, for your drivers, you need to have like your active drivers, and some of them churn and some of them are new and stuff like that. And same with your clients. And of course, you need to match them. And you see, like, for example, in demand in a marketplace like on track in December is way higher because of Christmas. And you need to meet the demand with more drivers then, but it's not easy. So it creates very complicated dynamics. So again, like in any marketplace, you need to make sure that all the parties are healthy and that the unit economics in each of the parties is healthy. And then other business models. We obviously need an other. The most important are fintech, and fintech is not the same fintech sector and fintech business model. Fintech sector is anything, like related to personal finances, for example, or anything like that, but they don't necessarily need to be fintech model. A fintech business model is where they have like significant item of financial assets. They loan money and they make profit from it, or they invest money. Well, there are many different kinds, but like the common thing is that they need to have financial assets. Therefore, they need large amounts of capital, of money. Because they will many times, by the way, and this is the third point, many times these companies raise a lot of money, and you see like in the news, like they just raised 100 million, and they're just starting. It's because a lot of that money is to be lent to clients, and only part of that money is to invest in the company itself. And at the beginning, that money, by the way, like if the company started growing, it's easier to get like money to lend, and like you finance yourself with banks and then you lend it. But at the beginning, that doesn't happen. So at the beginning, you start like raising equity to lend money, which is a very expensive way, but you have no other choice. And then hopefully you get to like private loans to finance it, and then bank financing. It becomes cheaper in time. Many times, by the way, in the equity, it's banks that invest, because in the end, banks are essentially like without the tech, but they are a fin model. So they are interested on creating fintech apps that they understand that they could incorporate to their products later on, as if Walmart had invested in Amazon. That would be like the comparison. They are very complicated to track as well, and these large amounts of capital makes it like complicated to build as well. And again, you need to like make more money from the money you lend than the cost that you have. By the way, they don't necessarily monetize by getting profitability of the financial assets. For example, Payflow, which is a good client of us, they lend money to employees during the month, but they monetize by charging the company a particular amount of money. Then B2B2C, like models based on data. Again, the typical thing of like, if the product is free, you are the product. So there are several ways to monetize this. Selling your database, like to someone else, direct advertising, using your users to advertise within the product, and banners, which would be like the most basic, typical banner of an ad that you see in many websites or whatever. So actually, here, my advice is that a ton of people think that they can make money from data of their product, like as a secondary business line, but it's not that easy. You need to have tons of data, and especially since GDPR in Europe, it's more complicated, and you don't have like so much data. So many people say like, okay, I'll make money from this, and I always say later. Focus in your main product. And then in many other startups, the R&D by itself is the true worth of the company. So actually, in fact, many health tech or many biotech companies don't even they don't even make money or have any revenue, and they aren't even planning on making any revenue because they are developing something that will be interesting for another corporate. So in fact, the startups, and this is something a friend of mine always says, they are like independent R&D departments. Many times also, like, people don't understand why startups keep losing money. And I always say, okay, the R&D department of a huge company, it's a cost center. And they know that it's like, they are losing money. They're like in the short term. But it may be very valuable in the future if it starts a new business line or whatever. So the way many times corporates buy a startup is because they did the innovation, and then they are like, okay, rather than spend so much time or so much effort and so much focus to do it myself, I'll buy it directly from a separate company. So that company maybe didn't even have revenue, but you want what they're doing. And in many cases, they do have revenue, but not on that, not on what they are researching, because that's still not mature enough. For example, these are 3 of our clients. Eindhoven, they are, if you go to the website or what you see is that an e-commerce for cardiology analysis. But the true value they have is a database and algorithms of millions and millions of signals, well, actually billions of ECG signals, which actually they have algorithms to read ECG analysis actually that are better than the ones in Stanford, for example. So they have like huge value on it. And I guess at some point, maybe a corporate that is big and on health or whatever, they buy them out. But they develop this e-commerce like for the moment to make money. Via, that I mentioned before, organic food e-commerce, but in reality, like the true value is that they have been researching and they have permission in the EU for commercializing miraculin, which is a substance that like changes like the sour taste to sweet, such that it has like many medical uses, or a sweetener, well, whatever. And validated ID, if you go to the website, you will see that it's that digital signature. But in reality, they are like one of the top companies using digital identity on blockchain. In fact, they are one of the 4 companies that like created the European regulation on it, something like that. That's a little technical, I'm not sure, but that's like their true value. And if anyone buys them out, or if anyone is interested in investing in the company, it's because of that. So they will analyze both parts. And an example that I put, for example, is based on LendMe, an American startup. I don't know it, so this was just like a model, and well, sorry, it's in Spanish, but I guess like easy to understand. So like data model based on database sale, commercial communications and banners, and then they also lend money. So you see like the balance of the performing loans that they have, and failed loans and stuff like that. So they monetize those 2 ways, actually, database and fintech, which I guess is 2 of the examples that we were seeing before. Any question? I guess it was more like in general explanatory, and we didn't go too deep in each one. But if there's any question, feel free to unmute, raise hand, chat, whatever. And if not, let's move on. So thank you very much for connecting. And next Thursday, we will go deep in SaaS. We will definitely deep dive on SaaS. I think, to be honest, SaaS is like what we are more experts on, I would say. Again, I would say that more than half of our clients are SaaS. And we will go actually in a lot of detail. So if you have a SaaS business, or if you are interested in SaaS businesses, we will go like to very specific KPIs, metrics, how to calculate them, meaning benchmarks and stuff like that. And that's going to be next Thursday at the same time. So thank you very much for connecting again. And well, sorry, I just saw in the chat. Well, it's just thank yous. All right, thanks to you. And hope to see you next week and in the coming webinars. Thank you. Bye.